All right, Econ friends, welcome back to another video in topic 10. So up until now, we've been talking about money. We learned what money's functions are, and critically, we talked about the different types of money, M1, M2, and the monetary base. That was really important. We're going to be talking about that today, so make sure you understand the components. We also talked last time about the importance of interest rates and how interest rates affect economic behavior, how they incentivize consumers to consume and businesses to invest, and therefore they have an impact on the C and the I components of our GDP formula, okay? In this final lecture, we're going to go into some technical discussion about the role of the financial banking system, and specifically, we're going to discuss monetary policy, okay? We talked last time about a few different things, so now we're going to jump into the banking system and then finish our discussion with a look at monetary policy, okay? So let's start off by, first of all, thinking about modern banking. And one of the critical things to understand is that modern banking systems are characterized by what is known as fractional reserve banking. This is very important. Modern banking is fractional reserve banking. You ask, what does this mean? Well, here's the key. In a fractional reserve system, banks are required to maintain only a percentage of their total deposits in the form of vault cash and other reserves. Say this again, that's really important. In a fractional reserve system, banks are not required to keep every dollar that they have on deposit in the vault or in the Fed Reserve. They only have to keep a portion, a fraction of that money. Banks are required to maintain only a percentage of their total deposits. So it looks something like this. Banks are going to have total deposits. Of this, only a portion, we're going to call this the required reserves. So of a bank's total deposits, only a portion, a fraction of that, called the required reserves, have to be kept in reserve. Those reserves can be held either in the form of vault cash, or they can be held basically in the form of other reserves. And often banks will park those required reserves with the Fed. We'll explain the Fed in some detail in a bit, okay? But the big takeaway here, banks have total deposits. Only a piece of it has to be kept as required reserves. Everything that's left over is known as excess reserves. And the key to excess reserves is that banks can loan them out. And if you think about what a banking business model is, a banker's business model, banks make money through loans. They bring money in from savers at a certain interest rate, they loan it out at a higher interest rate, and they capture the spread. It's called arbitrage, okay? So to understand the banking business model, you have to first wrap your head around the very counterintuitive fact that if a bank has $100 in deposits, it does not have to have that full 100 in the vault. Only a percentage is required. The rest is excess. So we take a look at this little simple example here. We have the university bank. You see that the university bank has deposits of $100 million. That's all the money that people have put in that bank. They do not have to keep the full 100 million in reserves. Instead, a portion of that 100 million has to be kept in reserves, which we're going to call required reserves. And the excess, what's left over, is excess reserves, okay? Digging a little bit deeper. A critical number, a critical rate here is what's known as the required reserve ratio. The required reserve ratio is the legally required minimum level of reserves. It's the required reserves that a bank must hold. And it is expressed as a fraction of deposits. Okay? The required reserve ratio, is the percentage that tells a bank, if you have this much total deposits, you have to hold this much in required reserves. Excess reserves, as we've mentioned earlier, are the reserves that a bank holds that exceed its required reserves. And here's the critical thing. Banks can opt to loan out their excess reserves. Let's go back up here to this example. Let us suppose, let's do little example or case one. Let's say that the required reserve ratio in this case, let's just say it's 12%. Let's say that the Fed, which we'll get to in a bit, they set a required reserve ratio of 12%. That means that banks must hold 12% of all their deposits in required reserves. Well, you see here that the bank has 100 million in deposits. So if the bank has 100 million in deposits, 12% of that would be 12 million. This would be the bank's required reserves. You see that the bank here has $12 million in total reserves. Therefore, they're meeting their required amount, but because their total reserves exactly equal their required reserves, they have no excess. They're still doing fine, but they have no excess reserves. Now let's go to case number two. Let's suppose that in this case, the required reserve ratio is 10%. Again, the bank holds 100 million in deposits. So they have 100 million in deposits. Because they have a 10% required reserve ratio, their required reserves are 10 million. But notice they have total reserves of 12 million. Since they have total reserves of 12 million and only 10 of those are required, this bank would have excess reserves of 2 million. So you can see right away intuitively that the required reserve ratio is going to be an important number that gives bank a sense of how much of their cash they have to hold and how much they can loan. Because you remember that reserves are broken into required and excess. And as we've said here, banks can opt to loan out their banks can opt to loan out their excess reserves. Now you say, okay, but why is this so important? And this, my friends, is the ultimate takeaway, the ultimate mysterious, magical thing in monetary policy. When a bank makes a loan, when a bank takes some of that excess reserves and decides to lend it out, banks create money. This is kind of mysterious, a little bit counterintuitive, sort of voodoo magical, but critical that you understand. This is a major point in monetary theory. By extending loans, banks create money. To understand why, or maybe how, you have to remember that M1 is one of the measures of the money supply, and that M1 includes checking accounts. The balances in people's checking accounts are a part of M1. M1 is a measure of the money supply. Therefore, the amount of money held in checking accounts is a portion of the money supply. When a bank issues a loan, fundamentally, the loan that the bank gives to one person will become a deposit in that person's checking account. Checking accounts are a part of the money supply. Therefore, when a bank makes a loan and the person who got that loan puts it in their checking account and increases their checking account balance, banks have just created money. Let's do a couple of scenarios here to really flesh it out. We have here a simple bank, the First University Bank. Suppose that a person puts a deposit in, okay? They put in a deposit of $1,000. This becomes a liability for the bank. Their deposits are $1,000. And at the moment, the bank, because it's sitting on it, has reserves of $1,000 as well. Let us suppose in this example that the required reserve ratio is 10%. And as a result of the bank's $1,000 in total reserves, we'll put total reserves there, 100 is required and 900 is excess. And you can see that here. The bank sets aside $100 for its required reserves. It then has $900 of excess, and this bank decides to loan that excess. What happens? Well, it plays out like this. That bank takes that $900 and they loan it out to a new person. Maybe that person is a consumer who wants to buy a car or take out a mortgage or do something else. Maybe that loan, the guy takes a loan, is a business owner who wants to buy some raw materials or build a factory. It can be consumption spending or investment spending, but the key is the bank had excess reserves and it made a loan. And here's where it goes. The person who gets that loan, they go and they put that loan into their bank, the Second University Bank. This becomes a $900 deposit at Second University Bank. But of course, from the lens of Second University Bank, of that $900, given a 10% required reserve ratio, only $90 has to be held. And 810 is considered excess. And what can banks do with their excess? Well, they can loan out their excess. So now Second University Bank takes the $810 excess and it makes a loan. And it makes this loan to another person, maybe another consumer, maybe another business owner who wants to buy a factory, buy a house, buy a truck, buy robotics, buy supplies. It doesn't matter. The loan goes out. This person takes the money to their bank. We'll call it Third University Bank, and they deposit that money into their checking account there. But remember, checking accounts equal money. So even though we started off with only $1,000 deposit, by creating a new checking account and then a loan and then a new checking account and then maybe even another loan, this process plays out and it leads to the creation of money. Because remember, my friends, checking accounts, the deposits that banks hold from you, those are considered money. So the big takeaway in this magical, mystical process is that by creating loans, banks create money. Notice that Third National Bank has $810. Given the 10% required reserve, only 81 is required, but the remaining 729 is excess, and you can bet and guess what this bank will do. They'll loan out 729 to another person who will put it in their bank, who will split that deposit into required and excess, who will loan out the excess, and the process can keep going for a real long time. In the end, if we were to factor all of these transactions, all of these loans, then the new loans, then the new loans, all the way through the financial system. If we added all that up, we can determine the total amount of money that will be created, the total increase in the money supply based on that initial deposit. Of course, that would be a bit of a pain in the ass, so we don't have to do it. Instead, we have a simple formula. We call this the potential deposit expansion multiplier. Or if you want some shorthand, we can just call it the money multiplier. The money multiplier is the maximum potential increase in the money supply that can emerge from each additional dollar change in bank reserves. Meaning, if a bank gets $1 of new reserves through the loan process, how much new money is created? The formula is very easy. The money multiplier is simply 1 divided by the required reserve ratio. In our example up here, the required reserve ratio was 10%. 1 divided by 0.10 equals 10. A money multiplier of 10 means that every $1 that goes into a banking system, every $1 increase in deposits, once this loan process spins out over time, will generate $10. If we go back up to our example here, this initial deposit of $1,000, we take the initial $1,000 deposit, we multiply it by the money multiplier of 10, and we would say that given a required reserve ratio of 10%, and therefore a money multiplier of 10, this initial $1,000 deposit will end up creating $10,000 of new money. It will increase the money supply, therefore, by $10,000. And you already learned what happens when you increase the money supply, okay? Note again, a key relationship here, part of the power of banks. The lower the required reserve ratio is, the larger the potential expansion in the money supply. And therefore, the required reserve ratio is going to be an important tool that we have to affect the money supply. And with that, we move into our final piece of this, which is a discussion of the Federal Reserve, central banking, and monetary policy. I'll cut this video now, and then we'll start that one up as a new one next. Thanks for your time. Do some review of this, do some practice questions, and I'll see you next time.